The year is 2026. Many expect that interest rates will finally come down and the global economy will get some breathing room. But when we examine the underlying trends, a different picture emerges. 26 may not be the start of monetary easing at all. It may mark the beginning of a new, quieter form of tightening. Why? First, inflation has become structural rather than cyclical. Unlike the surge after the pandemic, today's inflation is driven by deeper forces: geopolitical tensions, supply chain realignment, energy transition costs, and massive investment needs in AI and semiconductor infrastructure. These pressures do not disappear with a few rate cuts. Second, service sector inflation in the US and Europe remains persistently high. Costs for healthcare, education, insurance, and housing respond slowly, if at all, to lower interest rates. This is why the Federal Reserve and the ECB remain cautious, cut too quickly, and a second inflation wave could emerge. Third, governments face mounting fiscal strain in 2026. U.S. federal debt is projected to exceed $35 trillion, while Europe grapples with soaring defense budgets and the cost of the green transition. Higher government spending naturally increases inflation pressure, limiting how far central banks can loosen policy. As a result, even if interest rates decline, the overall environment may remain tight in practice. Liquidity could keep shrinking because the U.S. continues quantitative tightening. Europe is enforcing stricter fiscal discipline, and China is persisting with its deleveraging campaign. Together, these forces slow the movement of money through the global economy. Geopolitical risks amplify this uncertainty. Any escalation, whether in the Taiwan Strait, the Middle East, or Ukraine, could push energy and commodity prices sharply higher, triggering yet another inflation shock. So the more realistic scenario for 2026 is not rate cuts, broad economic rebound, but rather rate cuts, continued tightening, uneven, selective growth. Where might that growth occur? First, in sectors with unavoidable structural demand: AI, semiconductors, and power infrastructure. These industries are driven less by interest rates and more by global competition. Second, the trajectory of the US dollar will be crucial. If the US maintains a tightening bias, global capital could continue flowing into America, recreating pressure on emerging markets. Third, fiscal policy becomes the true guidepost for 2026. Rate cuts may grab the headlines, but it is government spending and strategic investment decisions that will shape the economic landscape. So even if interest rates fall in 2026, it may not signal the return of easy money. Instead, it could mark the onset of a new era of tightening, disguised as easing.